The best businesses in the world pay dividends. Think of companies like Meta, Apple, Microsoft, Google, and Visa. These are considered some of the highest quality companies in the world and also some of the largest companies. Now, there is a lot of misunderstanding out there about dividend stocks. In fact, some people say they hate dividend stocks and that no healthy growing company should ever pay a dividend. And this is an interesting point. If we look at the return on invested capital for these quality stocks, we can see they achieve very high returns. This means the projects that these companies reinvest their earnings back into are typically highly profitable, allowing them to achieve market-beating returns over time. So why would they ever use their capital to pay a dividend? To answer that question, we need to first dive into what is the main objective of management teams: capital allocation. Choosing how to properly allocate the free cash flow that a business produces is the most important thing that a management team can do. A company's long-term success entirely depends on these decisions. Now, when it comes to the options of what a company can do with their free cash flow, with their capital, they have 5 different options. They can either reinvest back into the business, they can do mergers or acquisitions, pay down debt, they can buy back shares, or they can pay out dividends. And out of these 5 options, there's 3 different outcomes. Obviously, reinvesting back into the business is investing for growth, mergers and acquisitions is also investing for growth, and then we have paying down debt. This is to strengthen the balance sheet, and then share buybacks and paying out dividends are ways to directly reward their shareholders. Now, the best way to use free cash flow is going to depend on many factors, and one of those factors is going to be the business life cycle that a company is currently in. For example, if a company is in the introduction phase of their life cycle. An example of this would be a company like Palantir. They just started trading publicly in 2020. These types of companies will typically do whatever it takes to grow. They'll use all of their capital to reinvest back into the business. And in fact, if we jump over to my stock screener and plug in Palantir's stock ticker, you'll see that not only does the company not pay out a dividend, they don't just not buy back shares as well, they actually issue more shares in order to reinvest more back into the business. So these types of companies are focused on doing whatever they can to try to grow. Sometimes it works and sometimes it doesn't. But the best businesses in the world are already past that introduction phase. They're still in the growth phase, meaning the company is growing their free cash flow at a high rate still. So why do these companies, if they're still in the growth stage, elect to pay out dividends? And we actually have a great case study of this with Meta. Earlier this year, Meta announced that they would finally start paying out dividend payments. If we come over to my profitability sheet and plug in Meta, we can see the company has a 5-year revenue CAGR of 19.29% and a 10-year revenue CAGR of nearly 33%. And the company has incredibly high gross profit ratios. If we look at some key balance sheet metrics for this company, we can see this is a company that is absolutely drowning in cash. Total assets over $256 billion, while total debt is just $49 billion. Look at total current assets, over $91 billion, and a current ratio of just 2.73, meaning the company can easily meet their short-term obligations. So this is a company that's absolutely drowning in cash. And if we look at the return on invested capital for a company like Meta, we can see it's very good. In 2021, 31%, 2022, 20%, and in 2023, 22.5%. But here's what's interesting. Over the last 4 years, it's been revealed that Meta has burned nearly $45 billion in cash in order to build Reality Labs, their metaverse. And this project has proven to be completely unprofitable. Why did this happen? Well, it's because Meta had a problem, and it's actually a really good problem to have. And it's a problem all quality companies seem to have. Meta had more cash than they knew what to do with. The company was already loaded with cash on hand, and the free cash flow per share they were generating every year was increasing at a rapid rate. And so yes, they were heavily reinvesting back into the business, but at a certain point, the highest quality companies in the world generate so much cash that they can no longer efficiently reinvest it back into the business. And that's the point at which capital allocation becomes so critical. The best management teams know that simply reinvesting all of earnings isn't always the best use of capital, as was the case with Meta, especially when they're already funding high return projects. And this gives them the ability to maximize shareholder value in other ways. So if we go back to the case of Meta, they were already heavily reinvesting back into the business and they could no longer reinvest and get high returns. There were no mergers and acquisitions opportunities and they already had a very strong balance sheet. So this left 2 options. They could start to buy back shares or they could pay out dividends. And we can see buying back shares was something Meta was already doing at a slight rate. And with the rest of the capital, they elected to start paying out dividends. And it looks like in hindsight, this is actually something they should have started doing just a few years earlier, because they could have already returned easily over $50 billion in dividends to shareholders, which would have actually increased the company's total return. Again, that's because this $45 billion right here saw no return on its investment. The exact same thing happened with Google earlier this year. They issued their first ever dividend payment and also announced a $70 billion buyback program. This is another quality company that's producing more free cash flow than they know what to do with. They're getting high rates of return on invested capital. Again, they're producing so much cash they can no longer efficiently reinvest it back into the business, meaning it's time to start paying out a dividend. But there's an important distinction we have to make between these high quality companies and other dividend paying stocks. And that distinction is they have the ability to pay out dividends without sacrificing any growth. And this is the exact reason we see these companies increasing free cash flow at a high rate every single year. Look at Microsoft and their 5-year free cash flow CAGR sitting at 13%. Back in 2013, the company was already paying out dividends. In fact, they paid out around $7.5 billion in dividends in 2013, and free cash flow was $24.5 billion. Despite this, 10 years later, free cash flow had jumped all the way up to nearly $60 billion. And here's the other important distinction we have to make. Because they're not sacrificing growth and free cash flow is growing every single year, the company has the ability to increase their dividend payments at a high rate every single year. Look at the past 10 years of dividend payments for Microsoft. They've gone from around 97 cents per share all the way up to $2.79 in 2023 and $3 in 2024. So when a high quality company with high returns on invested capital starts paying out dividends like Apple, Visa, or Meta, what they're doing is they're essentially telling investors, we're in such a strong financial position, we can afford to reward you without compromising our own growth. And when those dividends are growing over time, like we just saw with Microsoft, it's a sign that management is confident they're going to continue to grow their earnings and their free cash flow, and they're going to continue to get high rates of return on invested capital. So management teams having proper capital allocation plans is absolutely vital to any company. Reinvesting too much back into the business can actually lead to you wasting capital like we saw with Meta. But at the same time, paying out too much in dividends can actually hinder the company's ability to grow over time. So when a management team figures out how to properly balance all 5 of these capital allocation choices, it maximizes total returns. So as someone with a long-term time horizon who's looking to one day live off dividends, I understand that the highest quality companies in the world pay out dividends. These are companies with high gross profit margins, growing revenue at a high rate, with high levels of return on invested capital, and rapidly growing free cash flow. And because they're producing more cash than they know what to do with, they can pay out a dividend and a growing dividend without sacrificing any growth. So whether you're watching this video and before you watched it you loved dividends or you hated dividends, you have to understand whether or not dividends are good for a company completely depends on many different factors. And if a company can become one of the highest quality in the world, then they will end up paying out dividends. If you'd like to be able to download any of my spreadsheets and also be able to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.